Is the structural low officially in place? That's the million-dollar question, and as of right now, there's honestly some compelling evidence on both sides. Some things are saying, yes, let's trend higher again, and some things are saying, absolutely not, it's going to get much, much worse. Calling for a major low can be pretty polarizing, so I'd love to hear from you down below in the comments section. Regardless of which side you're on, this of course is the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, solid red-bodied bar with just a little bit of a lower wick. Certainly nothing meaningful to read into from a psychological perspective. That does mean that sellers are in control structurally. If we're thinking about location on the bar-to-bar count, notice that we do have a lower high, but a very substantial higher low. And if we actually take out a Fibonacci from the low of the capitulation gap down from 2 Mondays ago to the top end of that green bar, notice that this week we've closed over the Fibonacci 38.2. This classifies the weekly setup as a bullish 3-bar play here. It's an inside bar in the upper third of the previous week's range. I would imagine that stronger sellers would have tried to battle for price acceptance underneath the Fib 38.2, back down in no man's land between the 38.2 and the 61.8. It simply didn't happen, and for that reason, maybe we do read into that lower wick just a little bit. Not a lot, but just a little bit. Overall, it's still hard to say that the weekly chart is bullish here, noting that we do ultimately have a downtrend with highs. This is technically an equal-ish high forming the double top. We know that we've broken down through the neckline, producing a lower low, and this is the lowest low in the trend count. That means that this rally off of the low is nothing more than a counter-trend rally, and it's still very possible that the weekly chart could suggest a lower high can form here underneath the previous area of support from this lower wick back here, which is technically around 550. This is one of the major threats to the bullish base case, which we'll get into on the daily time frame chart. So that's one of the concerns. However, if you've been tuning into the past couple of videos, you know that one of my arguments is that if this is going to be the capitulation low, and these ranges are so wide and volatility is going to compress, I'm actually a believer that a daily higher low could coincide with a weekly higher low. And to be quite frank, the Fibonacci 38.2 that we just looked at would be a very compelling spot for that higher low to take place. We'll also build that argument out on the daily time frame chart in just a moment. That's a little bit more of the optimistic take. If we're getting back to reality, I would still point out that we're underneath the weekly 50 SMA, and if we bring out our Fibonacci from the last lower high to the lowest low, notice that this week we technically opened over the 61.8, could not hold that, and we're back down in no man's land underneath the 50% retracement and just a hair above the 38.2 here. Stronger buyers should have seen an open over the 61.8, tried to close over the 61.8, and in theory, the more weekly bars that close over this 61.8, the higher the likelihood of a 100% retracement. Clearly, that's not the case given what we've seen last week with the close here. If we take this one off and come in from the all-time high down to the major low, what you'll see is that we're back down underneath the Fib 38.2 after a somewhat, it wasn't the most, groundbreaking bullish development, but on the rebound, the counter trend rally from not last week or this most recent week of trade, the week prior to that, we closed just a hair over the Fib 38.2. We're back down underneath, unfortunately. So technically speaking, is it fair to call this bear flag consolidation down here? Absolutely, as of right now. If we take that off, another threat here on the weekly time frame chart comes from the anchored VWAPs, and we know that there's a cluster of anchored VWAP resistance above us, which almost coincides with the opportunity for that weekly lower high up against 550. So you can start to see how we get conflicting data points here on the higher time frame, where optimists might be saying something like, okay, look at the monthly higher low anchored VWAP from back here. We've technically closed right on it. We're at that Fib 38.2 from the low of the Monday gap down of 2 weeks ago, relative to the high of that move. So there's some optimism there, but I would say it's a far stretch to say that the weekly trend has the opportunity to flip to up in the coming weeks worth of trade. If we quickly check in on the volume profile, just to get one final say on the higher time frames, what do we see from this point of view here? Oops, did I grab the wrong study? I might have. Let's try that again with a weekly profile. There we go. The top end of this high volume node is exactly where we've closed as well. So optimists might say something like, well, If you're a stronger seller based on this gap down, you would have wanted to see a lower high underneath, and that's simply not taking place. That is true, but stronger sellers probably would also say, we're still dealing with a weekly downtrend, and just you wait, we're going to fall right back down underneath this high volume node. So I could see this data point going both ways. With that said, let's get a little bit more granular on the daily time frame chart here and start to evaluate what's going on. Should we be more optimistic about the higher time frame trend change, or should we say, nope, it's going to stay down, things are going to get ugly here? The first thing we'll evaluate is the weekly expected move. If you're not familiar with this study, it's this box right here. Check out the video tutorial in the top right-hand corner if you want to figure out how to ultimately set that range. If we're contained by the upper bound of the weekly expected move, the number is at 543.37, and that would imply an equal high to last week's move. It was technically going to be as well a lower high underneath the Wednesday high of the 90-day tariff pause candle, which of course was the historic 11.5% or so rally on that Wednesday session of 2 weeks ago. So a lower high or an equal high from that perspective. If we're looking at the lower bound of the weekly expected move, the number is 509.75, and unfortunately, it is underneath our do or die zone. There's now 2 do or die zones on this chart, annotated in orange here. The key support do or die zone is really what we're looking for to maintain our bullish daily base case for an uptrend to turn into a structural uptrend after this capitulation low back here. We covered this in detail in the Wednesday update video, but we'll do it one more time. The base case on the daily time frame for the optimistic bulls here, which is the category that I fall into, FYI, says that this is the capitulation low because the market gapped down on horrendous news, and yet the sellers were unable to continue to move prices underneath the opening print, never mind close underneath. The gap closed completely overhead, and obviously we've gone on to set 1, 2, 3 equal highs. The tariff pause day breaks those highs, bringing in a higher high in the trend count. If this is a low, this is a higher low, and the next ideal higher low would stay above the 3 equal highs from here, which is why we've labeled this as the do or die zone support on the downside. It's a little bit of a zone given the overshoot on Wednesday. Now that it's a 4-day week, that's actually Wednesday, right? Wednesday, a little bit of overshoot there as Jerome Powell was speaking. So we have 523.75 as the top end of the zone, and Thursday's low at 520.50 as the bottom end of the zone there. If the market can stay over that level, all sorts of funky zooms, let's try that again on Thinkorswim. If the market can stay over that level, I would classify this as a daily higher low, and I would maintain the optimistic stance that we've moved from a capitulation low to a structural higher low, and the trend is changing in the upward direction. Keep in mind also, now is the appropriate time to remember that we're moving along the MFU scale, right? This is the max fear. We have capitulation in the middle, and then we have euphoria somewhere over here. This is little e, big U, and that's how we get MF, EU with C in the middle. That's the scale. And what this refers to is the news cycle. And I want to be very clear about this because it continues to play a big role in the way the market's shaping up. Max fear is the announcement of tariffs way larger than anybody anticipated. That's the big move to the downside here. It's all the retaliation from China as well. Now, what you might recall is that technically Wednesday of this week, overnight, there was news that the tariffs on China had increased to 245%. We also had news overnight that NVIDIA was getting charged a record $5.5 billion export fee for some of their chips. You would think that that's also in the category of max fear, but the gap down was unable to breach underneath our key area from back over here. So just as much as this is a technical story about the key technical levels, the price action levels, the support and resistance we're talking about here, it's also a narrative on the news cycle. The news cycle where you would think, wow, that's got to be horrible, right? It was unable to break a key technical level. So what does that tell me? It means we're probably moving closer to complacency on the MF-EU scale. We're no longer in the phase of max fear. The market's almost gotten over this whole tariff tantrum, if you will. I'm not going to say it's completely over and oh my goodness, we should forget about it. Excuse me, brand new all-time highs in the blink of an eye. But we're certainly moving closer to complacency. And I suppose the bottom line for traders is that if you really believe the market should be trading back down here towards these lows, you're going to need a new and more aggressive catalyst. Not just like, oh, tariff this, tariff that. You're going to need something completely new, something that shocks the market and rattles it to its core, because we just saw on Wednesday of this week that the tariff news doesn't really matter anymore. We're going to go tit for tat with China for as long as it takes, and eventually, when and if there's any positive deal that's achieved there, you better believe that the market's going to start thinking about euphoria, right? So the narrative of the fundamentals aligns with the technicals here so long as the market continues to hold the do or die zone, and I would really just argue that this is the key area of the daily time frame chart that is going to tell us whether or not the base case is in play or whether or not we have to reevaluate. If this can hold here, and keep in mind that Thursday's session just the other day was an inside bar relative to Wednesday. The market really didn't trend anywhere on Thursday. Volatility compressed quite a bit, and we'll talk about how the VIX has moved from 50, oops, we want a 5, from 50 back down to sub 30. There's a classic saying on Wall Street, right? When you go from 50 to the downside, then good things can start to happen. And under 30 is when, wow, you're really coming off of a max fear event in the market. And we'll compare that back to the great financial crisis. So as a matter of fact, why would I even wait? Let's just go there now. And we'll revisit it when the time is right on the in the normal order of the show. But if we just bring up a monthly time frame chart here, max available, right, you can start to see how when the VIX gets up and over, we've got the 40 handle mapped out, but you can even bring out the 50 handle, which is somewhere right around in here. Right, so that's going to be your 50 handle. You go over 50 and then under 50, under 30 as well. 30 is this white line right here. Good things start to take place in the market. If you want to align that with the picture of the technicals of the chart down below, let's just actually make that a monthly time frame chart as well. Let's go monthly. Excuse me. And here we go. You zoom in a little bit on this so the time scales are aligned. Let's see, when the market moves underneath 30, so notice as I'm aligning my crosshairs, right? I'm aligning my crosshairs here, and that is right about here as the VIX moves sub 30 in the great financial crisis rebound, right? As you've moved from over 50, and this is very close to 100 actually, but as you move from that, the worst is behind you, and then the market obviously starts to see really good things happen. If you take a look at the dot-com bubble bursting, right, you could say that your max fear event was maybe this one right here. There's your 50 read up here towards the highs, back down underneath 30 as I hover my cursor, actually marks, right? So look at where my cursor is here. As I hover, you can see the crosshairs down below. It's actually right about in here, right? So good things start to happen after we move underneath 30 on the VIX. And it's not to say that this is an end-all be-all indication. It's not to say that, oh my goodness, Matt's saying that the market's got to go produce brand new all-time highs. It's one bullish data point in the entire narrative that we're starting to lay out right now, which would suggest that, yes, the capitulation low is looking like it's mostly in, and things can start to get better so long as, here's the big asterisk, right? So long as price can remain over 523.75 and 520.50 as a key area of support. I would be counting lows and then higher lows here to build out an uptrend. If you really want my personal take as to when I would truly say with confidence, yes, we're starting to really work this structural low out, it would be as soon as we make a higher high over Wednesday's high from the euphoric rally and invalidate the opportunity for the weekly lower high up against 550. So how might we get there? I would say it's really critical you watch Thursday's high of this past week, where if we can Brigade bolt over that, the target should be the top end of the weekly bar, which is closer to that upper edge of the weekly expected move. We're going to say that's around the 544 level. Beyond that, the next target should be the overhead gap from in here and a test of that weekly lower high at 550. If we can breach over the euphoric 90-day pause high, that's where I would say with much more confidence, okay, it seems to me that the structural low can be said with a little bit more certainty to be in. If we're underneath the do or die zone, this is where I would have to reevaluate the base case. It depends on how aggressive the move is underneath. If we get a big old Brigade bolt and just immediately take out this Thursday low from now 2 weeks ago, I would be concerned. I would think that, okay, something structurally has broken. We might be headed for more of one of, when I say structurally, I'm talking about something behind the scenes. There's a liquidity crisis. There is something going on in the financial sphere that shouldn't be happening, right? That's a new way of widespread panic, right? So if we take that out and we move back down to the equal lows here, then of course the base case is out the window. And I would say we, at minimum, even if you don't want to be bearish, you cannot really be bullish if this do or die zone gets taken out. If the market's truly going to make an advance in the upward direction, you really shouldn't see price acceptance underneath these three equal highs from back over here. So I think I've been pretty clear about where I stand on the daily technical analysis with that VIX component added in here. What we can do is take a look at the hourly time frame chart. You guys who are pattern traders, we've been talking about this for quite a bit. This, of course, was a double bottom. You have your Brigade bolt happening over the neckline of the double bottom here. The neckline is now the do or die zone. There's really not much to read into from that point of view. If we bring out the Fibonacci's from the low of the Wednesday session, when the tariff pause was announced, something that looks like this, the Fib 38.2 is close to the do or die zone high. We know that we've loosely been tracking that in here, and that would just add a little bit of confluence around that area. If we bring out, let's try the intraday anchored VWAPs, you'll also notice that the cluster underneath us coming from this before the big drawdown, gap down number 1, gap down number 2, ultimately the low in here as well is the white anchored VWAP towards the lows. That's where we supported on the overshoot from the Wednesday session when Powell was speaking. If you anchor a VWAP to the 90-day pause, we've closed slightly underneath, and this actually brings up the next possible, the logic behind the upside trade, right? If you're looking at this hourly time frame chart and you're thinking to yourself, how do I get involved in a move back to the upside here without like buying this at the highs or having to battle this anchored VWAP, that's the all-time high anchored VWAP FYI, then what I would say is if this is going to turn into now a double bottom, right? You have this double bottom back here. If this is a higher low double bottom over the do or die zone, then a breach of your neckline from that pattern at 531.75, something that looks like this, also gets you back up and over the anchored VWAP from the 90-day pause day. Right? So that to me is the compelling trade idea. That's the trade thesis. That's the location to unlock this sort of move in here to an equal high to the 90-day pause day. That's my pathing idea to the upside there. Obviously, just a straight up, drive that gets up and over this gap, because there was a little bit of a gap down, obviously, on Wednesday that remains unfilled. A little bit of movement over that gap with a higher low is also possibly risk reward up to the equal high of the week, and then also the Wednesday high from the 90-day pause. The gap close overhead really speaks for itself, and that would be up and over the upper edge of the weekly expected move. As we'll see based on volatility futures, the the expected move seems to be a little bit compressed still, considering that the volatility futures are still in backwardation. We'll get to that a little bit later. If we snap this entire zone, once again, this becomes the critical point to watch. I would at minimum be neutral, if not bearish, underneath this for the weekly lower high continuation. And then I would really make a more definitive bearish stance on this market if we were to take out the low here at 511.50. It's the August 5th yen carry trade panic low, as well as the Thursday overshoot after the Wednesday 90-day pause move also, okay? So that's how I'm thinking about this. That's the supporting evidence with the anchored VWAPs and Fibonacci's as well. My main pathing idea would be that this turns into a double bottom. We're constructive over the neckline, which is at 531.75, and we continue on in the upward direction. That aligns with the daily base case remaining bullish, and we will have to change our tone underneath this 520.50. Let's take a look at some more supporting evidence here. Let's begin with our market internals for the NYSE side of the exchange. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally speaking, let's think about two big data points here. Number one, what was the weekly bar? It was a solid red-bodied bar. We know that there's an unfilled gap down here as well, which means that in some sense, sellers did make progress in the downward direction last week. So, okay, if sellers made progress in the downward direction, are those sellers aggressive new money shorts, or does it seem to be some consolidation after this massive 11.5% update that we saw on the 90-day pause? That's how we should be thinking through the context of market internals. Well, if it was big aggressive sellers, I would certainly expect major volume outflows on the week. The only day we got close to that was when Powell was speaking on Wednesday, and we didn't even breach underneath negative 300 million. On Monday, we were over positive 300 million. Tuesday's inside bar was completely flat out of the volume flows. And you can see on Friday, even though it was an inside bar, we did see substantial volume inflows at the exchange level. That to me is not an indication that stronger sellers are aggressively shorting this as the pullback is taking place. You could make a similar argument here with the advanced decline line higher on Monday. Tuesday is over the zero line. Powell day, we're under the zero line, but we're not in trend lower zone. And then look at Friday. We close in trend higher zone up here on what was once again just an inside day. So do we really have aggressive sellers at the exchange level? I think the answer is no. Cumulative tick is the same story. Positive build, slightly negative on Powell's day, then flat to slightly positive on the Friday inside bar. Do we have aggressive sellers? Not really at the exchange level. I don't think anybody is willing to make a strong bet that, oh my goodness, the market's going to crumble and go to zero under the premise that all it's going to take is some positive resolution here the next thing you know, the market could potentially have another 10% plus up day. Who wants to be short when that's, something that's possibly looming on the horizon? So that's what I'm seeing at the exchange level. Let's take a look at the market profile, see if we can glean anything from this perspective. All I would call out here is that we did have a double distribution on the Wednesday session. Here's the upper, here is the lower. And notice that the value area of Friday was smack through the single prints. All that would tell me is that we've got a little bit of an indecisive market as we finished out the week, and pair that perhaps with the fact that the internals aren't really bearish and we're holding over the key daily high or low. I would think stronger sellers would have tried to battle for a majority of price acceptance inside the lower distribution. That didn't really happen. All it might take is a break of the inside bar high, and we're off to the races in the upward direction. Now, it's not to say that that can't happen to the downside, but notice that in C period here, there's much better excess on the low of the Friday session compared to the high. So the auction ended properly towards the lows more so than towards the highs. There's a good volume taper here as well towards the low of day. If I just zoom in on this, notice how this volume tapers much more aggressively than this, which is pretty stagnant, and then boom, towards the highs, right? So to me, a much more secure low rather than a secure high, meaning that if this is in need of repair, we would expect it to break when tested. Inside bar breakout to the upside, and you can start to see how the daily narrative in the upward direction, that daily bullish base case, lives on. Once again, will we have to reevaluate our tone if we take out Thursday's low? Absolutely. That's something, Wednesday's low. I'm losing it with these shortened holiday trading week. We'll absolutely have to reevaluate there, but as of right now, I don't think that that's really the base case that I'm personally seeing as a higher probability outcome. With that, let's jump back on over to the platform here. Let's take a look at our good friend, the QQQ NASDAQ 100. Let's see what's going on from the tech side of the things. The tech side of the market. Let's take a look at the weekly time frame chart. It's cleaning it up here. Candle structure, location, the whole 9 yards. Let's get into it. Solid red-bodied bar, a little bit of a lower wick. Same story as the S&P 500. Candle structure is technically bearish, but we do have an inside 3-bar play, which is technically bullish with the major higher low. Let's quickly check in on the Fibonacci's from the low of the bar up to the top of the bar. We're over the Fib 38.2, so once again, the close there right on the money, technically qualifying as a slightly more bullish than bearish setup. If we come in from this high, though, down to the low, where did we close? Supporting over the Fibonacci 38.2 is not horrible, but once again, it would have been better opening over the 61.8 to navigate back up here to close the weekly bar above, increasing the odds of the 100% retracement. Still underneath our good friend, the weekly 50 SMA, if we come in with the fib from the all-time high to the major low, we're back down underneath this fib 38.2, so we still have the threat of a weekly lower high at the same exact pivot in terms of general reference points, right? This previous wick is now acting as a possible lower high in the overall trend count, and we really don't have anything compelling for a weekly trend change other than the fact that this is an inside bar in the upper third of the previous week's range. That's really all the bulls have going for them here on the weekly time scale. If we check in on our good friends, the anchored view apps, we're underneath a majority of the cluster here, and we even closed underneath the monthly higher low pullback anchored view app instead of the S&Ps, which closed right on that anchored view app. So a little bit less compelling on the long side there. If we check in on the good old volume profile and zoom out here, and where did we land relative to this? Right at it. So right at the upper edge of this high volume node, we did not close underneath. So maybe the buyers could argue, okay, stronger sellers should have produced that lower high underneath. It's not happening. Slightly more bullish there, but that's a singular data point on the weekly time scale, maybe combined with the only other data point, the bullish inside bar, relative to the, 4 or 5 other bearish data points on the weekly time scale. It's possible that the daily and weekly higher low coincide with one another, but I think we want to start that from the smaller time scales. I would not be inherently bullish on the weekly until the daily actually flips that trend a little bit more confidently in the upward direction. So going to the QQQ daily now, you can see a similar story here where let's keep it in touch. Starting with the expected move, we've got the 460.61 as the upper bound. That's actually a lower high relative to last week's high, as well as the Wednesday 90-day pause high. If we look at the lower bound, it's at 427.70. It's a lower low underneath last week's low, as well as just inherently being underneath the do or die zone, as well as a lower low underneath the Thursday low of 2 weeks ago, which is where there was that first overshoot. So not really getting a warm and fuzzy feeling about the QQQ expected move here. I would still lean into the idea that we, just like the S&P, have an inside bar. It's possible that the capitulation low is in place. We have lows. We technically have a higher low. It's possible that this acts as a higher low. It's possible that this is the key level because we have 1, 2, 3 equal highs from the past. And if we can support over that, then you could, frame this a number of ways. But one of the easiest ways to always think about the market is, okay, if you're a stronger seller and you were participating on the gap down here and you were like, oh my God, it's time to rock and roll. It's going to crash. It's the dot-com bubble bursting all over again. Markets are going to see a 50% drawdown. If you're short from here, then staying over those 3 equal highs certainly is burning a hole in your pocket, and you're saying, okay, this kind of has to go now or never, otherwise I'm going to start stopping out of these positions, right? And this is where we get into this idea of the market climbing the wall of worry. There's always going to be something to worry about in the market, but as we talked about on the S&P 500, if we're moving to the right side of the MF-EU scale, I would generally think that the market has a little bit more of a propensity to drift in the upward direction. So daily timescale suggests that any consolidation here, it's an inside bar, right? So we're not ultimately making a big directional call in that space. If we can get over the Wednesday opening print, that's at 449. The first target should be the gap close to the Tuesday low. Beyond that, it's the equal high here at 465.85, and this would preserve the daily bull case, the daily bull base case. There we go, bullish base case. And we would look for that upside, right? 465.85 being the equal high target, the euphoric high from the 90-day pause rally. If we're underneath, this is where you can notice that the low of the Thursday bar is actually very close to this area. So although I would definitely neutralize underneath, you could see the zone here is 441 to 438.25. I would neutralize underneath that zone. I would probably wait, and you might be saying like, oh, okay, here he goes again, moving the goalposts a little bit. I personally would wait to get aggressively bearish to the downside until we breach this low with acceptance underneath. That's 435. Why would that be the case? Because the market's still resolving some degree of volatility. Yes, we talked about the VIX coming down a little bit, but my goodness, after an 11.5% update, it was slightly more in the NASDAQ. Is it reasonable that there's some overshoot, there's a little bit of chop and slop near these levels as we try to resolve things? I wouldn't maintain that aggressive bearish stance unless there's, number one, as we talked about in the S&P, a new catalyst that's extreme and we're underneath that do or die zone. In the NASDAQ, because this is so close, I'm not going to split hairs here and say, okay, I'm bearish and my target is underneath 438.25 to 435. That's not the type of range that I want to trade for. And I think that this is a great segue into the next comment, which is if we do have to change our tone underneath the do or die zone support in here, we have to remember that we don't just throw away all of the risk-reward principles that we trade by. You can't just arbitrarily start getting short at the lowest low of the move because you've decided, okay, the key level is broken. You still have to watch for a entry point that is reasonable enough to manage risk against, which probably looks something more like, okay, you break all of this, you set a lower high here, and now you're talking about risk-reward back down towards the equal lows. If that happens, then fine. But we're just not there yet. Notice that, again, we're all over the top end of that key zone, 441, 438.25, excuse me. Let's drop it down to the hourly time frame chart for the NASDAQ and see what else we can glean here. The pattern is once again the exact same. Here is your double bottom. There's the breakout. There's the Brigade bolt above. Here's your next higher low. If this is going to turn into a double bottom, we want to be over the neckline here, which is at 449. And then we have the gap close above. And if you're saying like, where's the trade there? It's risk and it's reward for the gap close, right? 2-to-1 or something along those lines if you could pull off better risk reward on a smaller intraday chart. And then beyond that, you're looking to balloon runners up into the equal highs here. The daily target we just talked about, 465.85. If the market's going to fall apart, you can easily see how in here we will neutralize and things start to get much worse if we breach this low and then move through the thin structure retracement, which is another way of also reminding me to point out that the whole reason why I would think we've turned bullish in the first place, or not the whole reason, but one of the data points that supports the idea that stronger sellers aren't here, is we remember that on this Wednesday rally in the upward direction, there were single prints this entire way up. And remember that the market should close those single prints with no issues. So on the Thursday pullback from back over here, the fact that we did not close the singles, we were taking that as a big sign that, okay, stronger sellers aren't present, and therefore that leaves a void for the natural buying activity of the market to take over, possibly drift in the upward direction. So all of these data points that I've seen so far probably lean on the daily and even hourly time frame charts that the buyers are in control and we're looking for this continuation in the upward direction. We're looking to turn the capitulation low into a structural higher low, higher low, higher low here, and ultimately we'll make some sort of equal high. If we can break through the equal highs, that's where we really start pounding the table and saying, hey, it's time to rock and roll. We're in a brand new uptrend. There's no reason to be overly aggressive on the downside. This is the optimistic take that we see here. I said in the intro that there are compelling data points on both sides. We'll get more into the bearish data points as we get into the intermarket relationships in just a moment, specifically around bonds, the long end of the curve, some of the breadth indications, the sectors. We'll get into it. I promise you, right? It's just bears hang tight here. I've got something for you too. Let's take a look at the intraday anchored VWAPs. The cluster is the exact same. The neckline break is the exact same here. And if we bring out the Fibonacci from the low up to the high, notice that the 38.2 is slightly over our key zone in there. What happens if we come in from the base of this to this? It's even further above, but the 61.8 is maybe confluence in here. Once again, that's your do or die Fibonacci as always. Let's take a look at the internals of the NASDAQ and see if this supports. Remember, the main question to interrogate here is, do we have stronger sellers? I would say that the NASDAQ actually has a stronger attempt from sellers to try to make something happen with the overshoot on Wednesday. Reason being is that unlike the S&P, when Jerome Powell was speaking, there's actually much more substantial volume outflows from the NASDAQ side of the exchange, which is noteworthy. You'll also see here that the advanced decline line did end up getting into trend lower zone, whereas the S&P or the NYSE side of the internals just hardly got a little bit negative, something that looked like this. So a little bit more bearish over here on the QQQ and the NASDAQ side at the exchange level. You can see the same indication here out of the Wednesday cumulative build relative to the bullish builds, the flat build and the bullish build here from Thursday. So if you're looking for shorts, if you're like, Matt, I really want to short this market, I do not believe that it's going to move in the upward direction, then the NASDAQ is your place to be. It's definitely not the S&P 500 because what's been driving some of the S&P return there is certainly some of the strength out of financials and just generally the idea that there's much more sector rotation that's available in the more diversified index. So that is the NASDAQ look. Let's take a look at the NQ market profile. I would rinse and repeat all the comments from our good friend, the ES market profile. You can see there are your single prints from the Wednesday session. Value is slightly lower. Point of control was underneath, whereas in the S&P, it was smack inside of those single prints, right? If we're looking at the auction at the low end of the day from Thursday, it is the same as the S&P. And once again, for anybody who's maybe not familiar with the single print conversation we were just having on the QQQ chart, this is what I'm talking about over here. There's the big rally day. There's the H period single prints. If I do something that looks like this, there's your indication that they did not close all the way. Technically, on this Thursday pullback, sellers should have moved all the way to here. They did not. That's one of the bullish takeaways as to why we started this bullish base case in the first place. Let's get back on over to the platform. Let's finish up our broad market indices with our good friend the Russell. We'll get to that in just a second. The internals, at least for the Russell, but let's start with our weekly time frame chart, and we'll actually go out to higher than a 3-year. We'll go to a 10-year just for the sake of doing it. And the reason we want to do this is such that we can see this range right here. So we'll get to that in a second, but let's stay congruent. Candle structure and location, as always. We've got a little bit more of a hammer-esque style bar out of the Rusty Russell side of the indices, and you can see that here. The longer lower wick suggesting some semblance of better support relative to the range that was traveled. So closing sort of more towards the midpoint of the range. It's still an inside bar. It's in the upper third, maybe actually closer to the middle of the upper half. If we take out the fib here, yeah, I'd say it's more so the middle of the upper half, right? So right here relative to your 50% retracement, it's in the upper half. Let's just generalize and say that. It's still technically a bullish location here with a lower high and a higher low, but relative to this, it's just not even close. It's not even close, and it's important that it's not even close, and that is why we grabbed the 5-year time frame chart. If I just do something that looks like this, it becomes very clear that any rally attempts out of the Russell easily run into a huge headache of overhead supply at your weekly 200 SMA, the green moving average on the screen, the top end of this previous range from back over here. This acted as monthly higher low support. Now it has a huge threat to act as a lower high. If we bring out the anchored VWAPs on the IWM, you can see we're underneath the entire cluster. Both of the all-time high attempted anchored VWAPs, the low attempted anchored VWAPs, this anchored VWAP, which really stemmed from the last major monthly high or low, this lower high. It's just brutal. There's no escaping the possibility of a threat for a major lower high up against 198.200 here on the IWM. If we bring out the Fibonacci's, let's actually remove these studies back to a simple 50 and 200. I just want to check in real briefly from the high to the low, just not even close. Notice that the 38.2 is at the magical spot of the 200 figure. If we come in from this lower high to the lowest low, we're underneath that 38.2. If we come in from this lower high to the lowest low, we never even broke up and over the 61.8. So it's a pretty tough argument to make and say something like, oh my goodness, small caps are in store from the for the biggest, most constructive rally that they've ever seen. It's just really, really tough to make that argument on the weekly or just any higher time frame scale. If we go to the volume profile on the weekly, and let's maybe zoom out here a little bit, just to check in on the high volume nodes, this of course is resistant at 200, the top end of the range, 1, 2, 3, and then 4 as support back here. If we bring this one across, we tried to support over it a little bit. That's this high volume node here, but generally speaking, it's the midpoint of the range. I can't make a strong argument and say that, yeah, like the other indices, we're looking for a weekly high or low in this area, and everything's going to be fine and dandy, and don't worry about this lower high. Much more bearish here out of small caps, which you probably want to carry forward as a headwind for the S&P 500, of course. Let's jump on down to the daily time frame chart here. Let's evaluate the weekly expected move. It's this box right here. Upper bound is going to be at 193.29. Lower bound is going to be at 179.60. It's an equal high to the Wednesday 90-day pause high. It's also a higher low relative to the lowest lows in the overall move, but it's a lower low underneath last week's low. The difference with the small caps is, of course, that this entire range has not broken out. Everything else was like, here's a major double bottom, and we've Brigade bolted over the double bottom highs. You're just not even there yet in the IWM. So the only constructive thing that we've been saying is that, okay, if this midpoint of the chop and slop is what we want to avoid, then I suppose last week was somewhat constructive, but there was not even an attempt to get up and over this high from back over here. It's a step in the right direction, but again, it's still a little bit more neutral than anything else. You could probably go out on a limb and say something along the lines of it's just a bear flag until proven otherwise. So therefore, your major threat would just be underneath 184.50, probably rotates to the bottom end of the range here at 176.50. If that takes place, then of course, this is a headwind for the S&P, and we will probably have to reevaluate the base case as being not so bullish anymore for the S&P 500. If you're looking for a constructive move to the upside, then like, fine, let's get over this reference high. And then let's also get at bare minimum an attempt and see what the reaction is like around 198.200. Remember that this zone right here is the weekly threat that we just spent so much time acknowledging and saying, hey, this is a big deal. Weekly lower high that persists underneath this area, it's just game over. It's nearly impossible to get bullish on small caps if you're underneath that key zone. So that's what I'm seeing here out of the daily. Let's take a look at the hourly time frame chart. You could build a similar argument where maybe if this is a really drawn out double bottom, you'd want to be over the neckline for some sort of compelling move into the top end of these Wednesday highs. That's over 187.75 into 190.25 is a possible idea. If you start seeing the breakout, then fine. Like maybe it's worth being a little bit more aggressive on the upside for the S&P. If you're just getting chop and slop inside of this range, then it's exactly that, right? So I would be neutral here. I would be cautiously bullish here, and I would just be right back to being bearish underneath, let's say BE for bearish, underneath 184.50. That's really all there is to it out of the IWM. Really not much more to read into other than that. We can come in from the lows with the anchored view, the Fibonacci's. 38.2 is reinforcing the exact level, 184.50. If we come in with the anchored VWAPs, we'll see the same exact thing. We're actually a little bit over the Wednesday anchored VWAP. So that might be, just the fact that this cluster is all supportive of 184.50. Maybe the first thought is neutral to bullish first, and that would be supportive of the more bullish take we've had thus far on the S&P 500. Let's check in on the Russell internals, and what do we see here? Better volume inflows on the Friday session. Friday actually did go on to produce a higher high relative to the Thursday high. Thursday relative to Wednesday produced a higher high. That shortened holiday week, again, throwing me for a loop here, on better internals than the downside from the Powell speech on Wednesday. Similar story over here, where you got closer to trend higher zone for the close, at least, relative to this, which is a little bit more in the midpoint of the negative side of the impression out of the advanced decline line. Unfortunately, though, through all of this, as the balance had taken place over the 4 days of trade, only one day was able to close positive on the cumulative build. So, you know, like we've been saying from the higher time frame point of view, it probably doesn't make sense to be this big raging bull looking for like massive upside out of small caps. Consolidation in here seems likely, maybe a small bullish edge with this amount of support underneath us at 184.50, but not taking out a second mortgage on the house to try to long this in the upward direction. Let's look at the Russell market profile, see what else we can learn about price action here. Value area was where? Here it is on the Monday, Tuesday, Wednesday, and Thursday, generally unchanged. And what I find maybe a little bit more compelling on the bull side for this is that on all of the attempts, all the forays underneath this level right around in here, really we've been using 1860. For anybody who's been showing up to the morning shows, we've been using 1860. Value was above 1860 there, and it was probably towards the upper bound of the weekly rather than pushed into these lows from here and over here. I'm not going to, again, say that this is the most bullish indication, but it probably supports a little bit more of the long thesis than the bear thesis. Let's get back on over to the platform. Let's jump into our sector analysis, and this is where the bears can start to have a little bit of their, what would we say? We'll give them their flowers, right? That's what they classically say. Who was leading, who was losing, and where was the weight? Real estate leads the pack, up 3.11%, followed by consumer staples, then utilities, and then energy. What do we know about every single one of those sectors? Well, first of all, every single one of them is lightweight, but more importantly, consumer staples and utilities in particular are absolutely more D for defensive. So as the market pulls back, it's not the worst thing in the world to see that, but if we're really looking for a recovery effort out of this market, we really don't want those to be the only green names on the sector board here. At the bottom end of the barrel, it is the semiconductors. Ouch, that's the heaviest weight risk on style indication, or the most concentrated risk on indication, not directly in S&P sector, but we know that the XLK is. That's the heaviest weight risk on sector, down 5.69%. Ouch. XLY consumer discretionary down 3.71%, another heavier weight risk on sector. Ouch. Communications down 2.48%, right? It's not really a great look here across the sector distribution, which is where we start to get into our bearish data points, which says, okay, slow your roll on the bullish analysis here. Yes, we're still holding the key level, and I would just remind you, right? Price pays. Sector analysis does not always pay, but price pays. So if we're over these levels, then all right, this is maybe making us a little bit cautious, but price pays, so we're good. But if this starts to break underneath and the sectors continue to look like risk off, I think the writing's on the wall, and we do not want to maintain the bull case as the base case for any longer than we need to. Let's jump into these structural charts and see what's going on. Real estate rallying here on a little bit of relief out of rates. Not much with all the wild bond volatility we've seen, but lightweight sector. Let's move along. Consumer staples looking like it's possibly ready for a breakout. Why would I say breakout? Well, 100% retracement, higher low, equal high. Over 82, you have the shot at an all-time high here, 84.50. A flight to safety into consumer staples is D for defensive. If the market tries to make a turn, when I say market, I'm talking about the S&P 500. If it tries to make a turn in the upward direction and it's led by consumer staples, red flag, and we will watch that very closely. XLU, the most bond-like sector, it's defensive in nature. We're sort of towards the midpoint of that. I would not say it's as bad as the XLP, but definitely not rainbows and butterflies over here. If we look at energy, it's still been absolutely walloped. So one of the things that energy continues to suggest is global demand slowing down, for energy at least. And we saw earnings from CSX on, what was it, Wednesday after the close, really didn't go so hot, talking about freight orders being down, demand to ship products right around is down right now. So that is congruent with the slowdown narrative that we heard from Jerome Powell as well, and the possibility that growth is going to slow to a snail's pace here, and maybe we start dealing with a slow growth situation or low growth situation, high persistent inflation. And what do we start talking about? We start talking about stagflation, right? So energy, although it's at least not suggesting inflation directly here, it's suggesting a threat to growth. So yay, hurrah, it's not going to be energy inflation, but it's going to be inflation otherwise, right? And we'll talk more about that when we get to goods and the tariff stuff in just a moment when we talk about bonds. Speaking of bonds, here's the TLT. Straight shot back to the downside. I think the relationship charts, the ratio charts tell us more here about what we should be thinking about bonds. Generally speaking, I think we've learned that this is not necessarily foreigners dumping U.S. treasuries, and it's more so just bond volatility. You have to think, like, globally, we've seen a little bit of currency going home. We've seen a little bit, specifically with Germany, right, in their infrastructure announcement. Some more encouraging rates there. The euro has moved higher, of course. So maybe a little bit of that, but generally speaking, this is more of a concerning look on that front rather than an encouraging look. So we'd want to see if bonds can maybe catch a little bit of a bid off of 85 and at least stay stable. We want the volatility here to slow down, which as of last week it actually did. It did just a little bit in here. So watching that closely, let's move along to semiconductors. Semiconductors are not encouraging by any stretch of the imagination. Why would I say that? Because as we talked about in the Wednesday and even last Sunday's update video, you needed to see two things. Either you needed to avoid the lower high here and break out through 211, or at bare minimum, you needed to hold on to 195.15. With the NVIDIA news on Wednesday, we're straight underneath that level. Now, ASML reported not great earnings, and their guidance was such that, okay, we're a little bit uncertain about what orders might look like going forward. But then on the Thursday session, I got it right this time, on the Thursday session, TSM, before the bell, reported solid earnings. They beat on both fronts, and they also said the guidance is fine going forward. We're not even going to adjust a thing. We're going to leave it as is. So it'd be really interesting to see if NVIDIA comes out, obviously much later on in the earnings cycle. They're notoriously late in the cycle. If they come out with really strong numbers, regardless of what this fee that they had to pay on the exports, right, is going to impact the bottom line as. So $5.5 billion, if they just say, you know what, it's no big deal. We're continuing to forecast fantastic growth on the new chips that we're producing. So we'll watch that. But for now, again, bottom line here, the takeaway for traders is that SMH underneath 195.15 has to be a little bit of a white flag. Slow your rope there a little bit on the bullish bias for the S&P 500. So I already know that a number of people are not going to make it to this point in the video, which is fine, right? But they're going to be commenting down below, but what about this? But what about that? We're acknowledging the bearish case right here. So if you've made it to the SMH, if you're seeing like where the concerns start to step in, then kudos to you. Thanks for having the patience to get through the analysis and like notably weight all the data points as they truly should be represented, right? Here's the XLK holding up just like the QQQ over the three equal highs. So far so good, but it's right there. 190.75 needs to continue holding as key support, and we need to rotate back up towards the equal highs. If we lose this, sayonara. Can't be as bullish on the S&P 500. Discretionary does not look good. This falls into the same category as the SMH. We are underneath the key area of what should have acted as support, 188. Is it possible that this is still a set of higher lows? You could maybe make that argument, but in a picture-perfect world, it should have been consolidation, and please, let's get up and over this threat from previous lows, now acting as resistance. Clearly, as they still act as resistance, the downtrend is intact. Let's take a look at communications here. Same story, underneath 91. So you can see the sectors are where we have concerns. It does not necessarily look good out there. Maybe you could make the argument for like equal lows in here, and this is a higher low shelf. But generally speaking, better bulls, stronger bulls, probably held up over these key levels in all of these key sectors. Just not the case. Healthcare, which is D for defensive, never broke out in the first place. We'll be watching that quite closely. But as of right now, with UNH gapping down so large like it did on Thursday morning, just not even a conversation point. So this looks bearish, undoubtedly. It's still in the range. I think we'll learn something either way when we do this or this. So patience out of healthcare. Industrials look good so far, but unfortunately, it's only 8% of the S&P 500 versus the XLK, which is over a third. As we take a look at financials, you can see that financials are looking good, right? And this is, again, one of the reasons why, with the semiconductors looking weak, the NASDAQ is probably the place to be looking for shorts versus the S&P, a little bit more diversified. We've seen some sectors that are okay. They're the lighter weight sectors. Some sectors not okay. But then your medium weight sectors, this XLF second heaviest weight, so I guess we'll give it some credit where credit is due, still over its key level. So 46.40 still holding out of the XLF. If we can stay over that, not bad. And ultimately looking for consolidation, you would say some sort of Brigade bolt, then looking for this gap to close overhead as the next major bullish indication to carry the S&P higher. XLB, the lightest weight sector in the lineup, still holding up over the key level, but more similar to the IWM. This entire thing was just a range. So possibility for a higher low, but show me some gap close here. The fact that this rejected the gap early in the week on Monday, Tuesday, leaves a little bit to be desired out of materials. Good thing it is the lightest weight sector by market cap. It's not going to make or break our good friend, the S&P. Let's jump on into our sector ratios. And I think here is, again, more bearish data. If you're not familiar with the ratios and how to set this up, check out the video tutorial in the top right-hand corner. This no longer is really showing you those opportunity for green shoots. You would have wanted to see this and then this to get over the 50 SMA. No good. As we look at the XLY, I don't know about you, but that looks like a lower high and a lower low. This is no good underneath the downward sloping 50 SMA. XLF is holding it together for the S&P 500, making it back up towards the equal highs. We'll give a check mark there. This is D for defensive. We'll say neutral out of healthcare. This is a no-go. This is relative strength out of the XLP consumer staples. That is not bullish. That is not risk on. Same comment here out of utilities, and we just made note of that when we were literally talking about the sector performance and the distribution of where those risk-off sectors were. As we take a look at some specialized ratios, we of course know that this wanted to see green shoots, make it to the 50 SMA, no good here. Same conversation, notice that we're much closer to the equal low, no good over here. Certainly a lower low here is no good, and this is trying for a higher low set there, but not as compelling as it could have been, getting some extension to or through the 50 SMA into the end of the week. You can also see the ARC ratio to the S&P. This is the innovation fund from Cathie Woods, is also just signifying nothing more than a lower high after producing a lower low. Tough to say that this is a risk on style look. It is risk off. As we take a look at risk on off the B set, this is gold up here. I've done a little bit of reconfiguration of the charts. This is the gold ratio, continuing to signal flight to safety. Risk off, gold, haven asset. Let's go there and just sort of ride out the storm. The volatility continues to outperform. As we take a look at Bitcoin, Bitcoin is still underneath its overhead supply, and we do not have a bullish Sailor shift firing of the signal yet to pass through the zero line here. So I'd say it's a little bit more neutral. It's not breaking down underneath the 71.5 level, but it's also not screaming, hey, let's rock and roll, everything's in the clear, let's move on up. TLT ratio to the S&P has the opportunity to offer a huge lower high, but I want to see a lower low. I want to see a lower low. You made an equal low here. Show me a lower low. I might be a little bit more compelled to start saying something along the lines of, okay, progress on the risk on front, but we are not there yet. So the bears, I told you you would have your moment, and this is where that moment exists. As we take a look over here, let's move into the dollar and interest rates. Dollar continues to look really weak down here, consolidating underneath this 101 interest rates, moving back higher after this nasty snapback off of 4%. I'd be interested to see where this dust ultimately settles out. It's tough to say how the markets, the bond volatility has been so high recently. It's kind of tough to say where rates might be headed, but I think what's starting to happen is with some of the fears and concerns you're hearing from Powell, maybe the higher for longer narrative, and we're not going to be able to see transitory tariff inflation. That becomes a little bit more of a reality as the 10-year moves higher here a little bit. So watching out for that. Let's take a look at, let's jump on over to our metals chart. I've done a little reconfiguring here. A lot of asks and requests recently for silver, so we've added that here. HG is copper for those who are unfamiliar. PL is platinum. There was another request for that. We can see that gold is the clear winner across all of that. And again, I think that this comes down to it being a safe haven asset. If we are going to experience a stagflationary environment, metals, commodities in general, should outperform. So I'd be interested to see if silver can play the catch-up game up towards these equal highs. Not as familiar with the way platinum moves. I'm going to have to do some studying on that. And copper as well could also be seen as an inflation gauge here, copper being in sort of everything. Everything electronic, at least, in terms of a conductor, right? So watching out for that. Copper on the rebound here, but not nearly as outperforming as gold up there in the top left. Let's jump from metals to, we talked rates on the TNX. Let's get into the inverted ZT so we can segue into the fundamentals here. What we see is just a sideways move out of the 2-year over the last week and a half or so, and we really haven't seen much movement out of the Fed tracker tool. If we just jump on over here, the odds have rebounded back to getting a pause in the next meeting here, and the fundamental alignment makes total sense. There's really no reason that the Fed would start cutting rates aggressively headed into the May timeframe when we would just be starting to get, we would just start to be getting, goodness, grammar here, we just start to see in the May report the April inflation numbers and whether or not tariffs are ultimately causing some degree of inflation or not. Whether or not Jerome Powell will comment on if they're transitory or not, we are yet to see. So far, based on his commentary Wednesday, it seems as though he's a believer that supply chains are more likely to be disrupted in a major way and cause more persistent inflation, and he sees the risk as being higher for more like a multi-year runway to straighten those things out as the damage gets done from the tariffs and just breaking of global trade, if you will. So we're still on pace for about 4 rate cuts into the end of the year. This is 1, 2, 3, 4, which would indicate that the market's still somewhat fearful that the Fed will have to bail us out. So we take a look at the calendar here. There was not much going on last week. Again, Powell's commentary at the Chicago Economic Club. The unemployment claims came in way better than the expectations here, beating by about 10,000. Not really an indication that we are overly concerned about a major recession based on employment here. These numbers are really stable, right? And you can even zoom out and just say, okay, there's really no reason to panic out of the jobless claims unless you start printing, let's slow down here, unless you start printing over 250 on the week-over-week initial claims, and that's just not the case. Continuing claims remain somewhat elevated, but elevated relative to their recent areas, but not at a breaking point where we would say, oh my goodness, the consumer is going to break, there's going to be tons of loan defaults, and it's just going to crumble, and the whole world's going to come coming down in a crashing move, just not there on the labor side of the information. As we look forward to what's happening next week, it's pretty quiet out there. There's a lot of Fed speak early on in the week. You can see all these Fed speakers here. And then I would say the biggest data point to watch out for is going to be your flash manufacturing and services PMIs. These are the first reads from S&P Global. There's not the revisions. It's the first look. So watching those, I think, will really be the next thing the market keys off of. I wouldn't say that durable goods and durable goods orders are a big deal, so much so on the Thursday morning. I'd say that the jobless claims continue to be interesting there, and that's really it. That's all we have next week. We have some Fed speak into the end of the week also. So generally, your PMIs, that's the big thing to watch out for. That is Wednesday at 9:45. Wednesday at 9:45 in the morning. Here is the earnings insight from FactSet, and one of the topics that we've been covering over the last little bit is as we go through this uncertain period of the tariff trade war, how many companies just straight up pull their guidance and don't offer anything, right? It's one thing to offer negative guidance, but it's another thing to pull guidance. So we haven't seen a continuation of that. One of the interesting things that happened was Delta, I believe it was, offered sort of 2 paths for guidance, which was interesting. But generally what I'm getting at with this quick look through the report is that there's a lot of negative guidance out there. If we just look at the percentage, you can see an overwhelming percentage outside of real estate, financials, and maybe a little bit of healthcare as well. Everything else is over the 50% mark for full year negative guidance here. And this does 2 things. As long as the guidance can stay in place like that, yeah, as it's announced, it might be bearish, but any beat in the next cycle of any of this expectation, you guide negative and then you come out with positive numbers, how does the market react? Of course, the market's going to be over the moon about that. You told me we were only going to make, I'm just making this up, right? They guided $1 per share, but they came in at $1.50 per share. Are you kidding me? Buy. This is like way better than we thought. This isn't bad. Oh my God, you beat it. We were prepared for the worst, right? So you got to play the mental mind game of expectations when it comes to guidance out of companies here. As I scroll down, what I think is a little bit more compelling, let's get a little bit further into this report, is that the EPS bottom up for 25 has just absolutely fallen off of a cliff, really since, if you take a look here early, this is the beginning of the year. There was a precipitous drop back in the September timeframe, but ultimately, as soon as the new year came around and our new administration started announcing the tariffs, so on and so forth, earnings have just been in the gutter, really, just aggressively moving in the downward direction. So that's something to be mindful of as we take a look at our estimates here. This is the quarter over quarter. We know that Q1 is supposed to be abysmal. Everybody's expecting that as of right now. And if we start beating a little bit more so into the back half of the year, once some of this volatility straightens out, that's maybe where things get a little bit more impressive to the upside. So watching out for that. These are the expectations. Again, The earnings game is an expectation game. It's not literally about the numbers at all times. Speaking of earnings, this is the calendar for the upcoming week. Your major contenders are going to be Tesla. Your major contenders are going to be, where are you? Alphabet, there you are. Those are the big ones that I'm mostly paying attention to. But aside from that, we have Intel, we have IBM, honorable mention there. We have Capital One on the financial front. You have your War Machine over here, Lockheed Martin, Raytheon. You've got ISRG, which used to be a heavy hitter in the XLV space. A little bit less concerned about that these days. Boeing could also be an honorable mention, as well as Chipotle, the world's most expensive burrito, might have some insights as to what their business is looking like right now. Are the consumers slowing down? Are they seeing pullback? Or is it just full steam ahead? With that, that's really the earnings calendar for this week, and we'll get back on over to the charts here, and we'll finish up our look. We've already looked at this chart. I've included it in the new risk on-off B section of the video, so we're going to probably remove this, but just to be clear on where that landed. Let's jump into bonds. I was talking about this the other day, and I think I actually glanced over something that's pretty important here. I was saying, do you guys like this? Do you guys not? One thing that I think is definitely worth calling out here is the longer end of the curve, the IEF-TLT, is going on to make higher highs and breaking out here, whereas this, the shorter end of the curve, the shortest end of the curve, the SHY-IEI, is clearly in a downtrend suggesting lower highs. What this starts to suggest is a concern about reflation. This is the long end of the curve basically saying, whoa, slow your horses here. Yeah, it looks like we're nearing the end of the hiking cycle, and obviously rates aren't moving higher on the short end anymore, but the long end of the curve is sniffing out inflation here big time. So I don't think I was clear enough in, this chart definitely still has its importance, and this is one of the things that I perhaps have overlooked in the past couple of video check-ins on this particular screen. So important, signifying reinflation, if you will, and of course this makes total sense with the tariff fears that the market is sniffing out. Let's take a look at, as we move along here, credit spreads. They're consolidating. They're more so sideways. I'd love to see, just like we were talking about in the TLT ratio, lower lows. Lower lows would be fantastic, but we just haven't done it yet. Have not done it yet. If we do make lower lows, it would start to be an indication that volatility is subsiding, and that would be a bullish indication for markets here. As we move along to junk bonds in isolation, notice the bullish divergence here with the equal high relative to the 90-day pause day versus the pullback into the end of week on the SPX. This might be a bullish positive divergence there. So we take a look at Bitcoin. We already sort of looked at this chart as well. This is baked into the risk on-off B charts now. Just pointing out one more time that we're still underneath the Saylor shift ratio on the negative side. As we take a look at total breadth, let's move along to this. Subtle improvements here off of the 250 SMA measures of the S&P. New highs versus lows creeping back up to the zero line. It'd be very compelling for the S&P to say, that's it, final, over for the low here if we started to see positive impressions out of new highs versus lows. Another thing to point out here is just such that, as I maybe try to sync up the crosshairs, let's see, is this in sync? It is. As you get into these really extended reads, right, look at where this is. There's a certain point where extensions like this start to mark bottoms just based on oversold conditions. Now, you can see that we're at the upper bound of this, but when the blue line typically overshoots that area, you're talking about like 15% here, 12, 15%, that's oversold enough where you would say, okay, this might start looking a little bit more like capitulation. So a subtle bullish data point that will pull out breadth-wise for the market to have officially bottomed in here. We'll continue to watch it. RSP looks constructive over its key do or die zone. That's 161 here. Same thing out of the QQQE, the equal weight NASDAQ, over its key zone at 8125. So we're all set on the breadth side. As we look at VIX, we already gone through a key analysis here on the zoomed out front, but I would zoom in here and just point out that as the market had pulled back, we've technically made lower lows. So what does this mean? Market moved lower, VIX moved lower, starts to signify that volatility is subsiding here. Even though the market's pulling back, it's not as fearful about, oh my God, let's be on edge and freak out at the smallest little movement. Let's take a look at volatility of volatility. VVIX, of course, same idea, pulling back here as the market pulled back, making new lower lows out of the VVIX relative to this consolidation here. As we take a look at volatility futures, these have been updated. The script here, we're moving into a less severe backwardation. We're still in backwardation, don't get it twisted, and this is one of the things that we would like to see subside if we were going to truly and confidently say that the market volatility is in the rearview mirror. We want these lines to flip positive. We're not there, but it's not nearly as severe as a backwardation. You can see this is a 3.5 point backwardation. We're currently sitting around 1 point. So, just for easy math, about a third less volatility here, or a third 2/3 improvement relative to what was happening on the gap down from the Monday low of just a few weeks ago. The one-day VIX also has not collapsed back down into its most comfortable range here. That will be a big tell also. Underneath 2145 is a big step in the right direction to subside volatility and confirm a little bit more of that structural low in the S&P 500. So we've gone through all the data points. I think that the sectors are the biggest threat right now in terms of the risk-on nature of this market, but the technical structure does look compelling on the long side. And for that reason, my base case is to say, for now, I'm looking for the improvement in the upward direction. I'm looking to see if the sectors want to improve as and if we try to make that attempt back up towards the equal high to the 90-day pause high the Wednesday of last week. With that, let's jump on into our core list of companies. Let's finish up here on a strong note. Then I've got 5 trade ideas for you. Let's kick it off with NVIDIA. NVIDIA is back in a dangerous spot, very similar to the semiconductors SMH ETF. You can see we're underneath 104.75, which is the previous low from back over here. For that reason, I would have to maintain a little bit more of a bearish stance until proven otherwise. If you're going to trade this, I think on the hourly time frame chart, we have the easiest indications here. This is where we have a long through the gap close overhead. Risk reward is what I would be fishing for on the upside. If you get over this 104.75 and you want an early shot at it, if you want this, I would say that your risk reward through this range could also be an idea. Overshoot, still lows, higher lows. I don't know that I would call this a higher low still, because from here to here you absolutely have a lower low. Maybe a daily higher low, just because the hourly trend has finally flipped to down, right? You had lows, there's now a lower low. So if you get back over 104.75, maybe the equal high becomes the target. The risk reward is here. You could try that out, but until proven otherwise, 104.75, if we're below, bears do have that edge. How would I participate short? Either rally lower high rejections, risk reward to the downside, or Brigade bolts underneath 99 to the downside there. Let's move along to Microsoft and see what's happening from a daily point of view. Another concerning chart here, getting down underneath its key area of potential support. 377.25 should have acted as Brigade bolt higher here. Obviously not the case into the end of the week. And your threat on the hourly chart, as we can now take a closer look, is we've seen 100% retracement. This is a lower high. We started to drift underneath on Thursday. If we stay below 368.50, just sayonara, thin structure retracement into 361. The only time that this would be bullish is on an overshoot. And this, if it looks like inverted head and shoulders, maybe there's a scalp long over 372 into 377.25. But when we get there, what should we think about? I would certainly think about a lower high given everything we just talked about on the daily time frame chart. Why would we be bullish if we're underneath 377.25? Just too much overhead supply. So another argument that you might make for the bears is just that our key, Mag 7 stocks honestly do not look good as of right now. Apple, are we looking good over here? Not really. Notice the inside bar back down underneath 200 doesn't really leave a lot to be desired on the long side. If anything, this hammer from the Tuesday session should have, in theory for bulls, right, yielded some sort of rotation back to the upside. Break the hammer high, get a movement back up here. Wasn't the case, accepting back down inside of this range. So Apple, specifically affected mostly by the China tariffs, is just not really performing well. It still seems like people are a little bit on edge here. If this is inverted head and shoulders, again, it's still got to be over 200. If this is just consolidation, it looks nothing more than a lower high, a break of the equal low, kiss it goodbye, looking for this zone. 184.15, 182 becomes the target underneath 192, 10 points to the downside in here. Let's jump on over to Nancy. Amazon is getting beat up. Let's take a look. Oh, look at the lower high on the Wednesday rally. Inside this range, never really attempted to hold up over the equal highs from back over here. It's honestly not looking hot in a lot of these names that we consistently track, which, again, I'll reinforce the point just because I feel like anybody who's made it to this point knows that we've taken a balanced approach, but anybody who skipped to the analysis of just the names was probably like, wow, way too bullish in the S&P, but now bearish in the broad market. The core list of companies, that's the acknowledgement, right? Consolidation under 177, bear flag. How could it not be? Thin structure retracement underneath 171, kiss it goodbye, 162.25 becomes your target. Where would I be bullish? Not even here. I don't like trying to take it through this grind. I would prefer to get here and then break out to the upside for the equal high if there's going to be a long that's over 183.50. Next up is Google. Another one with a 100% retracement. Lower highs persist, equal lows. Kiss it goodbye. I really don't see a compelling reason for longs out of Google here. Lower highs underneath 154.75. Keep a head and shoulders in place, something along these lines. If it is going to be a long, you would have to, at minimum, get over 157 and start to rally here. Why? Because of this overhead supply here, and this is sort of an interesting in-between zone, if you will. If the buyers were really going to make it happen, they should have supported here into the end of last week and early this week. It simply did not take place over 157, so the sellers definitely have a bit of an edge at this point. Metaverse, another incredibly bearish one, failed to break out here. All of the acceptance has been back down underneath that 554. I don't see the reason to be aggressively bullish here. Maybe an overshoot and a counter trend. Here I would start searching for some kind of lower high. Retest, rejection, Brigade, bolt, technically from this point of view here. For that style rotation, that would be at 529.85. If this is just a nuanced bear flag, I mean, heck, do yourself, knock yourself out. Draw the trend line. If you break the trend line, maybe it's a move through the thin structure into the open of that Monday gap down at 486.85. Again, not really seeing the compelling look on the long side here out of Meta. Tesla is the most neutral out of most names we've seen so far. Here's the daily time frame chart. This is the daily balance that we're referring to. The Monday gap down did not really move underneath these lows, but keep in mind, Tesla had already been down over 50% from top to bottom of this overall move. Peak to trough, it's pretty ugly. So the consolidation is there, but is this nothing more than just a bear flag on the higher time frame? I mean, I don't see it as being that. I don't see it as being anything other than that as of right now. On the smaller time frame, in terms of what's happening in here, let's go to the hourly to see it. It's just nothing more than a balance range breakdown. Early on the Thursday session, it was starting to look like maybe look below and fail over 241, but no dice to close out the session. So we'll be watching 241 very closely. If it is going to be look below and fail, I mean, this higher low should set up the move to the 260 mark over time. So it'll be something to watch, but with earnings on Tuesday after the close, might have to put this one on the back burner and just say, well, wait until earnings are over and then just reassess the chart afterwards. The implied volatility before earnings might just be unpalatable for any sort of options trade to unfold. So that's the idea. The main idea is to watch the look below and fail, but whether or not we can participate becomes a totally different story based on options mechanics. As we look at JP Morgan, looks okay. Financial sector also looked okay, as we just saw. So staying over 228.75 is great. I would say that this, as a micro inverted head and shoulders, probably sets up long trades early in the week over 233.65 to 238. It's a possibility to watch out for. Anything above that, this 241.25 is the next major battlegrounds based on what you can see here as being the gap close. Right, if you can get over that gap close, a little bit more compelling for, all right, we're a little bit more so in the clear, and this remains constructive for higher lows and building out a new uptrend. Netflix, earnings on Thursday after the close, kind of weird with Friday being a holiday. You can see here on the bid-ask spread, we're about 1,006, 1,007. So we're going to be opening slightly over this pivot high back here, which is interesting because if this is going to signal a major double bottom, if we can hold over that, I mean, in theory, you're looking for the all-time high. So gap rules will likely be in force on the Monday open. We'll talk about it in the pre-market prep when we get back together up in the office on Monday morning at 8 a.m. for our classic stream. Let's get into these 5 trade ideas. The first one is going to be on Costco. COST is the first one here. And what we're looking at is a daily double bottom. We're looking at a capitulation low that is easily in the rearview mirror. We're already trading back up to these equal highs from the earnings cycle on the gap down back here. And notice the higher lows on the way. If we take a look at the hourly time frame chart, any consolidation over 987.50, it's just a bull flag here on the hourly looking for the gap to close. That's 1,002 to 1,020. If we fail underneath, final stop, final chance is something that looks like this over time. 968.25 is your do or die area of support out of Costco to preserve higher lows, higher lows, higher lows, and a higher low around that zone. The gap close is really what we're targeting overhead, but if you need the next target beyond that, it's 1050 on the upswing. Next up after Costco is in the financial space. Let's go on over to Visa, new to the financial space from the tech sector recently, but notice this, right? If this, I mean, not that it's you would never put that in a textbook, but goodness, if we can stay over this previous low on the mild pullback here, the daily bar on Friday doesn't look all that compelling, but if we could hold up over this zone, then I'd be interested in possible longs, not really up to this, but through the breakout point becomes a little bit more compelling through some of the thin structure back here. 338.25 into 350.50 is really what I would be talking about. So here it is on the hourly, and you could probably bring in a helper level here and say, okay, if we can breach up and over 334, let's make that gray and dotted. There we go. If you could turn this into a double bottom and Brigade bolt here, then fine. That's like a strong long idea. But for now, a little bit more of a back burner. And until it gets here and maybe breaks out like this, that's where I'm looking for the long. That's the 338.25 for the upside move there. That would help out the XLF as a sector. Next up, some lesser or newer names. They've been on fire before this whole tariff tantrum, if you will. But let's go Fortinet, FTNT on the cybersecurity side. And let's take a look over here. So this was a great breakout from back before everything sort of went sideways. But for now, look at the overshoot of the bottom end of this range. Hold the daily 200, rebound back up towards an equal high here. Bull flag starting to consolidate over these prior equal highs at 94. 100, if I just extend this off to the left, was also the big bad round Jesse Livermore number that was keeping the stock back over here. If you can get a breakout over 100, you have thin structure retracement to the scene of the crime at 106.25. So here it is on the hourly, just to sort of illustrate that. Again, in here, just let it do its thing. But over 100, we might have a thin structure retracement from this breakdown, 106.25 acting as the target. Another one that's similar in terms of its style is Rubric. RBRK is the ticker on that. As we take a look over here, let's start on the daily. You can see it's similar, where this is maybe inverted head and shoulders. You're consolidating back over these previous pivot lows. On the capitulation gap down, we held the daily 200. And now we've rebounded back. This thin structure is what we're ultimately looking to retrace. That's over 63.60 to 67.50. That's the bottom end of this consolidation here. And then there is an unfilled gap up towards the highs as well. That's 71.35 to 73.30. Here it is on the hourly. And you could start to see once again, let the consolidation be. Brigade bolt here. Thin structure starts to retrace. And then we're looking for the gap to close overhead as the next possible target. This is in play as long as 59 continues to hold, coming from these prior lows back over here. Last but finally not least, it's the fan favorite. It's still in play. It is PLTR. Oops, PLTR. There we go. Palantir is what we're looking at over here. Just astounding relative strength. Never really got much acceptance underneath these lows and the capitulation gap down. Immediate rebound, equal highs, no hang up at this level here. Now acting as support at 90.75. Consolidation. Let it fly over 97.55. Looking for the thin structure retracement. 107.75 is still the target. This idea is unchanged from when we brought it up on the Wednesday session. It is still in play. We even brought it up back over here with the double inside bars. It's a beautiful looking chart. The structure is clean, and this will be a top watch as we head into next week, as it has been for the last couple of weeks. That's all I've got for you in today's episode of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comments section, and I would also love to hear from you. Am I being way too bullish? Am I out of my mind talking about a capitulation low turning into a structural low? Did I miss a data point that you're looking at that's suggestive of like, dude, you're crazy, stagflation's on the horizon, and this thing's going to zero? I'd love to know. If I've got a blind spot, let me know down below in the comments section. Thumbs up goes a long way. And reminder, we will be live on Monday morning, 8 o'clock Eastern time, as we always are, for our episode of the pre-market prep, building a game plan to set you up for the trading session. With that said, have a green trading week, and I will see you in the next one.